Have you ever looked at your investment portfolio and just had that nagging feeling, am I actually doing this right? One of the biggest questions that trips people up is, how many mutual funds is too many? Well, today we're going to break down a really simple rule that could completely change how you build your portfolio, and definitely for the better.
So let's just start with a quick check-in. I want you to think about your own investments for a second. Is it possible, just possible, that you're making one of the most common portfolio mistakes out there without even knowing it?
You see, there's this idea in investing that more is always better, right? The thinking goes that if you own 10, 15, maybe even 20 different mutual funds, you've basically achieved peak financial safety. It sounds like you're being super diversified and smart, but are you really?
But here's the twist. What if that strategy, that belief that you're playing it safe, is actually doing the exact opposite of what you want? What if holding all those funds is quietly, slowly dragging down your long-term returns? That's the surprising truth we are going to get into today.
Okay, let's dive right in. First up, we need to tackle what I like to call the over-diversification myth. It is time to pull back the curtain on this idea that more is always better. So here's where things get all mixed up. On the one hand, you have the common belief, more funds equals more safety. But the reality? It's that more funds usually just means more overlap. Seriously, think about it. How many different large-cap funds are all buying the exact same big-name stocks? You think you're diversifying, but you're actually just buying the same companies over and over again under different fund labels.
And that leads to this problem called over-diversification. It's basically when you own so many things that your potential returns just get watered down. Your whole strategy becomes, well, a confusing mess. Your money is spread so thin that even your best-performing funds can't make a real difference to your bottom line.
So, if having 15 or 20 funds is actually a bad thing, then what's the right number? Well, that brings us to Section 2, the 3 to 5 fund rule.
So what's the magic number? You're going to love this. For most investors who are aiming for long-term growth, it's just this, 3 to 5. That's it. 3 to 5 carefully chosen mutual funds. I know, it might sound almost too simple, but its simplicity is exactly what makes it so incredibly powerful.
So why does this work so well? Well, for starters, you get all the real diversification you actually need without all that useless overlap. Plus, your portfolio becomes so much easier to track and manage. You know exactly what you own and why you own it. This focus is key because it means each and every one of your investments can have a truly meaningful impact on your growth.
Okay, so what does this actually look like in practice? Let's move on and actually build out a simple but powerful portfolio and see how this all fits together.
Here is a classic, super effective 3-fund setup. You start with one index or large-cap fund. This is your foundation, your core stability. Then you add one flexi-cap or multi-cap fund. This gives you balanced growth across companies of all sizes. And finally, you bring in one mid-cap fund to add that little bit of extra kick, that higher growth potential.
And this is really the most important thing to get. It's not about collecting funds like they're trading cards. It's about building a team where every single fund has a clear, specific job to do. Stability, balanced growth, and high growth potential. That's a powerhouse combination right there.
But what happens if we just ignore all this and keep on adding funds whenever we feel like it? Let's explore the real consequences in Section 4, the dangers of too many.
Make no mistake. A cluttered portfolio is a dangerous portfolio. It actively waters down your returns. It makes figuring out how you're really doing next to impossible. You totally lose sight of any clear strategy, and boom, you're right back in that over-diversification trap we talked about earlier.
Okay, let's put some numbers to this to make it super clear. Let's just imagine you have 10,000 rupees to invest this month.
And this chart illustrates the problem perfectly. Look, in a focused 3-fund portfolio, each fund gets a solid investment, more than 3,000 rupees. But if you spread that same 10,000 across 10 different funds, each one only gets 1,000 rupees. That tiny amount just isn't enough to move the needle, even if one of those funds has a spectacular year.
All right, let's bring this all home. In our final section, we're going to focus on the single, most important, actionable thing you can take away from all this. This is the one rule to remember.
But first, you might be wondering, how on earth do people get into this mess anyway? I mean, nobody wakes up and says, you know what I want? A really confusing portfolio.
Well, it almost never happens all at once. It's more like a slow creep. It's driven by really common mistakes. You buy a fund because a friend gave you a hot tip. You start chasing whatever fund was number one last year, and, this is the big one, you just don't take the time to review what you already own.
And before you know it, your portfolio's bloated with funds that add absolutely no real value.
And that brings us to the golden rule, the single most important rule to follow from now on. Before you ever add a new fund, you must ask yourself one simple question. What clear, distinct purpose does this new fund have that my current portfolio is missing? If you can't answer that question instantly, you don't need the fund. It's that simple.
So if there is just one thing you take away from our time together today, please let it be this. Smart portfolio building is not about having more funds, it is about having the right funds. And finally, just a quick reminder for you, this has all been for educational purposes. Mutual fund investments are, of course, subject to market risks, so it's always a good idea to chat with a qualified professional before investing. Thanks so much for hanging out with me today.